On the morning of March 10, 2023, federal examiners walked into Silicon Valley Bank's headquarters in Santa Clara, California. By midday, the building was no longer under the bank's control. In 48 hours, depositors had pulled $42 billion out, roughly a quarter of all deposits, leaving SVB with a negative cash balance of $958 million. The withdrawal requests were so massive that the bank's own internal systems crashed. This was not some obscure lender. Silicon Valley Bank was the 16th largest bank in the United States, holding $209 billion in assets. Nearly half of all venture capital-backed startups in America kept money there. Weeks earlier, Forbes had named it one of the best banks in America for the 5th consecutive year. The question wasn't just how a bank collapses in 2 days. It was why the people running it had spent years dismantling the very safeguards designed to prevent exactly this. Empire building. Silicon Valley Bank was founded in 1983 over a poker game. The idea was simple but innovative. Build a bank that speaks the language of technology startups. Traditional banks wanted collateral and revenue history, things early-stage companies didn't have. SVB filled that gap. It understood burn rates, venture debt, and the relationships between founders and investors. Over 4 decades, that positioning made SVB indispensable. Companies like Airbnb, Cisco, Pinterest, and Fitbit all banked there. SVB required exclusive banking relationships from borrowers, binding startups to the institution from their earliest days. By 2021, pandemic-era monetary policy had flooded the economy with cheap money. Venture capital flowed freely. Startups raised enormous sums and deposited the proceeds at SVB. Between 2019 and the end of 2021, deposits surged from $62 billion to roughly $189 billion, tripling in just 2 years. That abundance is precisely where the trouble began. Fraud mechanism. Explain clearly what SVB did next was not criminal fraud as prosecutors have framed it so far, but it amounted to a catastrophic failure of fiduciary responsibility dressed up as prudent banking. SVB was sitting on a mountain of startup deposits. Management wanted better returns, so they invested roughly $80 billion into long-term bonds, U.S. Treasuries, and mortgage-backed securities. Safe against default, but not safe against losing value. When interest rates rise, existing long-term bonds fall in price. Think of it like buying a house at the peak of the market, then watching rates spike. Your house is still a house, but if you need to sell tomorrow, you're taking a loss. SVB classified $91 billion of its bond portfolio as held to maturity, an accounting designation that kept declining market values invisible on the balance sheet. By the end of 2022, unrealized losses on that portfolio exceeded $15 billion. As long as nobody needed the money back, this was theoretically manageable. But SVB's customers were startups, and startups burn cash. When interest rates climbed and venture funding dried up, those companies began withdrawing deposits to fund operations. The slow drain had begun. Red flags. The warning signs were everywhere. In April 2022, SVB's chief risk officer stepped down. For the next 8 months, through precisely the period when the Federal Reserve was aggressively hiking rates, the bank had no one in that seat. The position wasn't filled until January 2023, weeks before the collapse. A 2021 Federal Reserve review had already flagged multiple deficiencies in SVB's risk management. The bank failed to address 6 citations. By autumn 2022, San Francisco Fed officials discovered SVB was relying on flawed internal models. Models that incorrectly predicted rising rates would improve the bank's position. Meanwhile, the bank had quietly unwound most of its interest rate hedging, dismantling its own defenses. And the person overseeing all of this, CEO Greg Becker, sat on the board of directors of the Federal Reserve Bank of San Francisco, the very institution charged with supervising SVB, system failure analysis. In 2015, Becker personally lobbied Congress to exempt banks with under $250 billion in assets from stricter Dodd-Frank oversight, regulations passed after 2008 specifically to prevent catastrophic risk accumulation. In 2018, he got his wish. The threshold for enhanced supervision was raised, and SVB slipped below it. The Federal Reserve's own postmortem acknowledged that supervisors were too slow to escalate concerns, and that changes to regulatory culture had made routine oversight less rigorous. The San Francisco Fed had discretion to examine SVB annually once it crossed $100 billion in assets. It did not act with sufficient urgency. This is the architecture of systemic failure. An executive who lobbies away his own guardrails, a regulator who watches problems mount without intervening, and an accounting framework that allows billions in losses to remain invisible. Collapse. On March 8, 2023, SVB announced it had sold its entire liquid bond portfolio, $21 billion, realizing a loss of $1.8 billion. To plug the hole, management would raise $2.25 billion in new capital. Coming days after the crypto-focused Silvergate Bank began winding down for similar reasons, the announcement triggered a wildfire of panic. Venture capital firms, including Peter Thiel's Founders Fund, told portfolio companies to pull deposits immediately. Social media amplified the fear at unprecedented speed. By close of business on March 9th, $42 billion was gone. Another $100 billion was staged to leave the next morning. On March 10th, California regulators seized the bank. The entire unraveling took less than 48 hours. One detail bears emphasis. 11 days before the collapse, CEO Becker sold $3.6 million in company stock. CFO Daniel Beck sold an additional $575,000. In January 2025, the FDIC sued 17 former executives and directors for gross negligence and breach of fiduciary duty. Human cost. The collapse created immediate chaos. Roku disclosed $487 million, 26% of its cash, was trapped inside SVB. Roblox, Vimeo, Etsy, and payroll processor Rippling were all hit. Over 200 UK firms confirmed they couldn't meet payroll. Startup founders lined up outside branches across Silicon Valley, waiting for information nobody had. Y Combinator CEO Gary Tan called it an extinction-level event for startups. Many had one account at one bank holding everything. When that account froze, their companies froze with it. The government guaranteed all deposits on March 12th without using taxpayer money. HSBC acquired SVB's UK arm for £1. First Citizens Bank shares eventually bought the commercial banking business. But US banks collectively lost $100 billion in market value. European banks shed $50 billion more. Regional bank stocks, First Republic, Western Alliance, PacWest, cratered, some losing over 60% in a single day. Psychological autopsy. What drove SVB's leadership here was not a single reckless bet. It was something subtler. The progressive erosion of caution during apparent success. When deposits tripled, management saw opportunity, not risk. When rates were low, long-term bonds looked disciplined. When regulators asked questions, flawed internal models provided reassuring answers. Each decision, investing in government securities, classifying bonds as held to maturity, lobbying for lighter regulation, could be rationalized in isolation. Together, they formed a chain of escalating vulnerability, with no circuit breaker, no chief risk officer for 8 critical months, no hedging strategy matching actual exposure, and the CEO sitting on the board of the institution, tasked with watching him. The instinct to believe your own success story is the most reliable predictor of institutional failure. Reflective ending. The collapse of Silicon Valley Bank was not a story about bonds or interest rates, though those were the instruments of destruction. It was a story about what happens when an institution becomes so embedded in its own ecosystem that it loses the ability to see itself clearly. The 40-year relationship between SVB and Silicon Valley was built on trust. The collapse revealed that trust had quietly been converted into complacency, by executives who lobbied away their oversight, by regulators who deferred when they should have demanded, and by an industry that assumed its favorite bank was somehow different. The scaffolding of easy money held everything in place. When it came down, the structure behind it was never as solid as anyone believed.